Hi, I'm Jim Zogby. Welcome to Viewpoint. This is my first show back after our Ramadan break. I hope you all had a blessed Eid. Tonight we're going to discuss Muslims in America, and we're going to do it with the first woman president of the Islamic Society of North America. Then we're going to talk about the elections, and we're going to do that with William Beeman. He's editor-in-chief of Politics Magazine. But first I want to welcome Peter Tanis. He's president and CEO of Links Investment. Mr. Tanis is the author of several books on finance, including Investment Gurus, a widely acclaimed book that explores the careers and theories of some of the greatest money managers and financial academics of the 20th century. Frequent guest on national television, especially busy these days with the meltdown on Wall Street. He's also founder of the American Task Force on Lebanon and the author of a new book, The End of Prosperity. I have it here with me, and it's not out yet.
Be out next week.
Couldn't be a better time for it to come out.
I know, sadly.
Thanks for joining us, Peter. I want to back into the discussion about the markets because I think there's going to be a different degree of understanding among those out there watching and with myself. The difference between you and I is probably on this issue is where the market was and where it currently is. So let's talk about the market as we begin.
Sure.
Today was another devastating day of loss for Wall Street. Without getting into all of the numbers, you said that this was the single largest loss the last 6 days. If it was the end of the year, this would be the biggest loss since the Depression.
Since the first of the year,
yeah.
If today were December 31st, it would be, the market is down 38% year to date. This would be the single largest annual loss in the stock market since the Great Depression.
In terms of wealth, in terms of dollars lost, what does that represent, this kind of decline in the market?
It represents several trillion dollars. Much of the wealth that is in pension plans, 401ks, retirement plans of individuals. So there is an enormous amount of fear and concern out there. I've been in the business, Jim, for 45 years. This is the worst I've ever seen.
I want to talk about pension plans in a minute, but it reminds me that when my brother John Poles, he's developed a term, the investor class, which 20 years ago were guys who looked like that character on the Monopoly board. You know, it was
with the high hat.
The big bankers and the high hat guys, right? They either made money or lost money, but there's some 40% of the workforce today are in the investor class through pension plans, et cetera. This is not just an issue for Wall Street. This is an issue for working men and women across the country whose pension plans have been hit. I saw a story in the Wall Street Journal that said that since in the last 15 months, $2 trillion lost in pension plans.
Indeed.
How does that get made up? Can it get made up? And what can be done to salvage that? Because these are folks who are counting on this money for retirement, and it's not going to be there. When they finally get their quarterly reports from T. Rowe Price or TIAA-CREF or whatever plans they're in for a big shock as to what their portfolios look like.
Indeed. And in fact, before we discuss how this crisis started and how it got to where it was and where it's going, I should point out that the number 40% is understated because many people, workers and others, have some form of their retirement in mutual funds and 401ks. So a great many Americans and others around the world are affected by this because it's a global crisis. Essentially, we have a crisis of confidence, which was started by a crisis in the credit markets. As you know, liquidity froze up. Today, the big problem is that banks and financial institutions aren't lending because they're afraid to lend. It's not that they don't have the liquidity, they do. Moreover, the $700 billion bill that was passed last week is going to provide increased liquidity, but it won't help unless the financial institutions have enough confidence to lend.
Why are people selling off?
The market is selling off because it is witnessing an economy that has come to a standstill and which is choking. The anecdotal evidence out there, and I hear it every day, of people who are unable to get loans, who are perfectly creditworthy, people who can't get loans even if they put 50% down on a house and they have perfect credit, is an indication of how serious the situation is. And the market is spooked. The market sees no reason to turn around, and it feeds on itself, because what happens is, as the market declines and investors get scared, if they don't own stocks, they may own mutual funds. They put in redemption orders for their mutual funds, and the mutual funds have to turn around and sell stocks to meet the cash redemptions.
How low can it go?
It could go down another 10%. Although today, based on most valuation models, including well-known ones like the dividend valuation model and several others that the Federal Reserve uses, prices are undervalued. Stock prices are undervalued by 40 to 50%. Indeed, we are at a level in valuations for stocks that we haven't seen since 1974, which was an all-time low.
What does that mean? Does that mean that this is a time for somebody to buy stocks?
It's a time for somebody to buy stocks if they have very strong stomachs. Okay. See, the problem is, if you had a pile of cash, this would be a great time to buy stocks, and you'd look back in 2 or 3 years and say, gosh, what a genius I was. The problem is that most people aren't in that position. They are looking at a portfolio that has gone down 30 or 40%, and they don't have any extra money to buy. They're looking at losses.
I saw a proposal. John McCain the other night proposed that the part of that $700 billion that was set aside for a rescue plan for banks, part of that he wanted to shift to a rescue plan for homeowners. I saw another notion that the federal government ought to buy up these 401ks and reissue to the holders treasury bonds. Is there money around? Is there money around for this?
There's money. The good news is that under the $700 billion bailout bill, which was passed and signed by the president, the Treasury and the Fed have a fair amount of discretion as to how they use it. So yes, there are a lot of different ways they could use those funds. Most of them, like including the two you mentioned, are largely impractical and would take a long time to set up the mechanism to do. But the increase in liquidity to the financial institutions that got in trouble will be starting within a week. We just hope that the stock market will start to see evidence of this liquidity and will react positively. But for now, as we speak today, the declines have been devastating.
So a person out there who's got a home mortgage issue, he's having trouble with it, somebody who is wanting to buy a house and can't get a loan, somebody who wants to buy a car and can't get a loan, at what point will what the Congress did kick in and ease up the situation so they might be able to go shopping again?
Jim, in all those cases you mentioned, the answer is within a couple of weeks. Okay. It'll happen very quickly. The guy who's not going to get a loan is the guy who bought 3 houses with 0 money down because he thought he was going to sell them for a higher price next year. That guy can go bankrupt for all anybody cares.
So but that house across the street from me that has under contract, yeah, it's going to be under contract for a while.
Oh, yeah.
Okay.
Nobody's going to buy that one. But your neighbors who may be having trouble paying their mortgages but who are employed, but their rate just reset to a higher rate, they're going to get taken care of.
I'm going to bother you because you're here and I know what you do for a living. Mm-hmm. For folks out there listening, what would be the smart thing for them to do with their pension plan, with investment, et cetera? Where should they go right now? Should they just ride this out and take the hit now and then hope it bounces back, or are there things they can do?
Here's what we tell our clients. If anything proves that we are not clairvoyant, this certainly does. Nobody could have foreseen a decline of this magnitude. The only thing we can do, the only advice we can give, is to make sure that your risks are spread out appropriately. This is called asset allocation. So you understand what parts of your portfolio are the riskiest and what parts are the least risky, and you make sure they're divided up in a way that suits your own ability to tolerate that risk. So much in stocks, so much in bonds, so much in real assets like gold or energy and others, and you come up with a mix that works for you no matter what happens.